Many people invest all of their money in stock market because they believe that it is the best investment as it can provide a higher returning income. However, there is a saying that don't put all of your eggs in one basket. I would interpret it as don't put your entire money only in one investment or only in stock market. Rather, diversify your money in different investment avenues. However, if it's not in stock market, then what? Is there any other opportunity which gives people a better return than MT? If you want to know more about this, then watch our video presentation. So, the type of investment which I am talking about is bonds. But before we proceed to our detailed discussion, I will give a short overview about our topic. Let us first define what is bonds. As you can see in the screen, the definition of bonds is the kind of investment security where an investor lends money to a company or a government for a set period of time in exchange for a regular interest payment. In Tagalog, ang bonds daw ay isang uri ng pagkakautang. Halimbawa ay pumunta ka sa isang bangko, kukuha ka ng isang loan. Yun po ay isang uri ng pagkakautang. In return, doon sa capital na binigay sa iyo ng bangko, magbabayad ka ng interest on a regular basis and you need to pay or you need to return the principal.
The first objective, describe the characteristics of corporate bonds. Many people believe that stock investments are always the best investments. And while stocks have historically outperformed other investment options in terms of returns, bonds are frequently regarded as a safer investment when compared to stocks or mutual funds. In fact, in difficult economic times, bonds are regarded as a safe harbor. Corporate bond. A corporate bond is a type of debt security that a company issues and sells to investors. It is also a written pledge to repay a specified amount of money with interest. The company receives the capital it requires, and the investor receives a predetermined number of interest payments at either a fixed or variable interest rate. When the bond reaches maturity or expires, the payments stop and the original investment is returned. A bond has several features: face value, also known as the par value, maturity date, and bond indenture are all forms. Face value. The face value, also known as the par value, is the cash amount that the bondholder will receive when the bond matures. The usual face value of a corporate bond is 1,000, but the face value of some corporate bonds may be as high as 50,000. The total face value of all the bonds in an issue usually runs into millions. The corporation pays the bondholder interest at the stated interest rate between the time of purchase and the maturity date, usually every 6 months. Always keep in mind, in some financial publications, the interest rate is referred to as the coupon rate. This example will help you fully understand face value by illuminating how to calculate it. Assume you purchase a 1,000 corporate bond issued by Xerox Corporation that matures on May 15, 2018. The interest rate for this bond is 6.350%. Using the following formula, you can calculate the annual interest amount for the Xerox corporate bond. The following formula can be used to calculate annual interest is dollar amount equal to face value multiplied by interest rate. For this example, our face value is the 1,000 corporate bond issued by Xerox Corporation. while our interest rate is at 6.350%. Do note that you need to convert the percentage to decimal. So the 6.350% will be 0.635. After converting, you will proceed to multiply the face value and interest. In this situation, you receive interest of 63.50 a year from Xerox. Maturity date. A corporate bond's maturity date is the date on which the corporation must repay the borrowed funds. In the previous example, the maturity date for the Xerox bond is May 15, 2018. At the maturity date, the bondholder returns the bond to the corporation and receives cash equal to the bond's face value. Maturities for corporate bonds may also be classified as short-term for under 5 years, intermediate term for 5 to 15 years, and long-term for over 15 years. The actual legal conditions for a corporate bond are described in a bond indenture. A bond indenture is a legal document that details all of the conditions relating to a bond issue. Since corporate bond indentures are difficult for the average person to read and understand, a corporation issuing bonds appoints a trustee. The trustee is a financial independent firm that acts as the bondholder's representative. Usually, the trustee is a commercial bank or some other financial institution. The corporation must report to the trustee periodically regarding its ability to make interest payments and eventually redeem the bonds. In turn, the trustee transmits this information to the bondholders along with his own evaluation of the corporation's ability to pay. If the corporation fails to live up to all the provisions in the indenture agreement, the trustee may bring legal action to protect the bondholders' interests.
Good day everyone. Today, I'm going to discuss the Objective 3, which is explain why investor purchase corporate bonds. Psychology of investing in bonds. Bonds are another way to use asset allocation to diversify your investment. The term asset allocation is the process of spreading your money among several different types of investment to lessen risk. The second one, investor considered government and corporate bonds a safer investment when compared to stocks because a bond must be repaired at maturity. Bonds may provide more growth and income potential than other conservative options. There are 3 reasons why investors purchase corporate bonds. The first one is interest income. The second one, possible increase in value. And lastly, repayment of maturity. In interest income, bondholders normally receive interest payment every 6 months. The dollar amount of interest is determined by multiplying the interest rate by the face value of the bond. In fact, interest income is so important to bond investors. As you can see in your left side is the interest calculation. To explain the example, assume you purchase a $1,000 corporate bond issued by the AT&T Corporation. The interest rate for this bond is 6.70%. The annual interest is $67. The formula, the dollar amount of interest is equal to face value times interest rate. To substitute, the value of face value is $1,000 and the value of interest rate is 6.70%. But first, we need to divide the interest rate to 100 to move the decimal point, then multiply. $1,000 times 0.0670 is equals to $67. The investor will receive $67 a year, paid in installment of $33.50 at the end of each 6 months period. In interest income, there are 4 types of bond. The first one is registered bond. Registered bond is a bond that is registered in the owner's name by the issuing company. The second type of bond is registered coupon bond. The registered coupon bond is a bond registered for principal only and not for interest. In registered coupon bond, only the registered owner can collect the principal at maturity, but interest payment can be made to anyone. To collect interest payment on a registered coupon bond, the owner must present one of the deductible coupon to the issuing corporation or the paying agent. The third type of bond is bearer bond. Bearer bond is a bond that is not registered in the investor's name. Bearer bonds are generally issued by the corporations in foreign countries. The last type of bond is zero coupon bond. Zero coupon bond is a bond that is sold at a price far below its face value, make no annual and semi-annual interest payment, and is redeemed for its face value at maturity. With the zero coupon bond, the buyer receives a return based on the bond's increased market value as its maturity date approaches.
Dollar appreciation of bond value. Changes in overall interest rate in the economy are the primary cause of most bond price fluctuations. In reality, an increase or a decrease in interest rate can affect the price of a bond. The value of bond may also be affected by the financial condition of the company or government unit issuing the bond. The factors of supply and demand, an upturn or downturn in the economy, and the proximity of the bond's maturity date. As you can see in your right side is the computation on how to find the approximate market value. The formula is approximate market value equals the dollar amount of annual interest divided by comparable interest rate. For example, assume you purchase a Verizon Communications bond that pays 5.5% interest based on a face value of $1,000 until the bond's maturity in 2017. Also, assume new corporate bond issues of comparable quality are currently paying 7%. The approximate market value of your Verizon bond is $786. To begin with, we need to first find the dollar amount of annual interest rate. The formula for this is dollar amount of interest rate equals the face value multiplied by the annual interest. Substitute, the value of face value is $1,000 and the value of annual interest is 5.5%. First, we need to divide the 5.5% into 100 to move the decimal point. Then multiply. $1,000 multiplied by 0.055 is equals to $55. Then find the approximate market value, which is the formula is approximate market value equals the dollar amount of annual interest divided by comparable interest rate. To substitute, the value of dollar amount of annual interest is equals to $55 and the value of comparable interest rate is 7%. Then divide the two. $55 divided by 7% is equals to $786. To conclude, if you purchase the Verizon Communication bonds for $786, you will receive $55 interest each year until the bond's maturity. You will also be repaired the $1,000 face value at maturity, which results in $214 profit because the bond's value increased from $786 to $1,000 between the time of purchase and the maturity date. Bond repayment at maturity. Corporate bonds are repaid at maturity. After you purchase a bond, you have two options. The first one is you may keep the bond until maturity and then redeem it, or you may sell the bond at any time to another investors. In either case, the value of your bond is closely tied to the corporation's ability to repair its bond indebtedness. To diversify their investment portfolios, some investors use a concept called bond laddering. Bond ladder is a strategy where investors divide their investment dollars among bonds that mature at regular intervals in order to balance risk and return. The mechanics of bond transaction.
Most bonds are sold through full service of brokerage firm, discount brokerage firm, or the internet. Then lower commission for discount brokerage firms. Then brokerage firm charge a commission when you buy a bond and when you sell a bond. A commission may be a combination of stated dollar amount plus an additional commission, or what we call markup when we buying and markdown when selling.
So let's proceed to objective 2. Why corporations sell corporate bonds? The corporations sell corporate bonds because the corporation don't have enough money to pay for major purchases. So when we say major purchases, ito yung mga big operation na tinatawag. Everything that exceeds $10,000 are counted as major purchases. Ang example niyan ay buying manufacturing plants, equipment, machinery, building improvements, and buying computers, vehicles, and trucks. Next is that they need to finance a corporation's ongoing business activities. Ongoing business activities entails operating activities relate directly to the business providing its goods to the market, including manufacturing, distributing, marketing, and selling. The third one is difficult or impossible to sell stock. Next, they want to improve a corporation's financial leverage. The use of borrowed funds to increase the firm's return on investment. Kapag sinabing financial leverage, ito yung mga strategic endeavor of borrowing money to invest in asset. The goal is to have the return on those assets exceeds the cost of borrowing funds that paid for those assets. And lastly, to use the interest paid to bond owners as tax-deductible expense that reduces the taxes the corporation to pay to federal and state governments. Before we proceed to types of bonds, let's first identify the difference between stock and bonds. So, nabanggit kanina na it is impossible to sell stocks. So, what is stocks ba? Stock daw po is also known as equity. It is a security that represents the ownership of a fraction of the issuing corporation. Units of stock are called shares, which entails the owner to a proportion of the corporation's asset and profits equal to how much stock they own. There are two main types of stocks, common and preferred stock. So, ang natakila lang natin ay yung difference ng dalawa. The main difference daw po between preferred and common stock is that preferred stock gives no voting rights to shareholder while common stock does. Preferred shareholders have priority over company's income, meaning they are paid dividends before common shareholders. Next, let's proceed to corporation bonds. A corporate bond is a debt issued by a company in order for it to raise capital. So ang investor who buys corporate bonds is effectively lending money to the company in return for a series of interest payments. But these bonds are also actively traded on the secondary market. When we say secondary market, it is simply where the investors buy and sell securities they already own. So, let's proceed to types of bonds. So, when we say debenture, it is a debt instrument used by companies and government to issue the loan. The loan is issued to corporate based on their reputation at fixed rate of interest. Debentures are also known as bond, which serves as an IOU between users and purchaser. Companies use debenture when they need to borrow the money at fixed rate of interest for its expansion. Debenture has four types: secured and unsecured debenture, registered and barrier debenture, convertible and non-convertible debenture, first and second debenture. Since yun naman yung ating focus, let's tackle the advantages and disadvantages of debenture. The advantages of debenture are investors who want fixed income at lesser risk prefer them. Second, financing through them is less costly as compared to the cost of preference or equity capital, as the interest payment on debentures is tax deductible. The company does not involve its profit in a debenture. And lastly, the issue of debenture is appropriate in the situation when the sales and earnings are relatively stable. Let's proceed to disadvantages of debenture. Each company has certain borrowing capacity. With the issue of debenture, the capacity of a company to further borrow funds reduces. Next, when redeemable debenture, the company has to make provision for repayment on the specified date, even during periods of financial strain on the company. And lastly, debenture put a permanent burden on the earnings of the company. Therefore, there is a greater risk when the earnings of the company fluctuate. So, mortgage bond. A mortgage bond is a type of bond secured by mortgages that is typically real estate or other real assets. The assets are also known as the collateral of the bonds. Mortgage bonds protect lenders and allow borrowers to borrow larger amounts to lower cost. The bonds can be securitized into a mortgage-backed security and sold to investors in the secondary market, which allows the bondholders to transfer risk. Mortgage bonds provide several advantages to both borrowers and lenders. Holding a claim on real assets, the lenders of such bonds bear lower potential losses in the case of default. Mortgage bonds allows also less creditworthy borrowers to access a larger amount of capital at lowering borrower costs. Mortgage bond can be securitized into financial derivatives and sold to investors, which provides more liquidity in the capital market and allows the transfer of risk. One of the drawbacks of mortgage bond is that it is the risk of losing the collateral if the borrowers fail to make the payments. Although the lender obtains ownership of underlying collateral, it is also the case that the lender can sell the collateral for any amount that can full cover the less. Collaterals are usually sold at prices lower than the fair market value at comparable assets. So, yung pangatlo is subordinated debenture. It is an unsecured loan or bond that ranks below other, more senior loans or securities with respect to claims on asset or earnings. Subordinated debentures are thus also known as junior securities. In the case of borrower default, creditors who own subordinated debt will not be paid out until other senior bondholders are paid in full. Subordinated debt is riskier than unsubordinated debt. Subordinated debt daw po is any type of loan that paid after all other corporate debts and loans are paid. In the case of borrower default, borrower of subordinated debt are usually larger corporations or other business entities. Subordinated debt is the exact opposite of unsubordinated debt, in that senior debt is prioritized higher in bankruptcy or default situation. So, ano nga ba yung pinagkaiba ng debenture at subordinated debenture? A debenture po is a type that does not use collateral. It otherwise recognizes any unsecured long-term debt. Because the bonds are unsecured, it is imperative for the issue to be profitable for the corporation. Because of its lack of collateral, this makes the bond more risky. This risk means the bond should pay a higher interest rate in order to compensate for the risk. The greater the risk, the greater the interest rate should be because the issue does not have collateral to pay in case the corporation is not profitable. A subordinated debenture is similar in character, however, in this case, they are paid as subordinate issue. This leaves the subordinate debenture acting as a junior debt to the more senior debenture in case of insolvency. As you might imagine, these issues, although linked to the debenture, pay a higher interest rate. In the case that a corporation does not become insolvent, the more subordinated a note is, the more risky it could be. Imagine a serious issues with senior debt and junior debt. This flows of funds from corporation to the bond investor happens like a funnel. So, yung pang-apat po is convertible bond. A convertible bond pays fixed income interest payments, but can be converted in the predetermined number of common stock shares. The conversion from the bond to stock happens at a specific times during the bond's life and is usually at the discretion of the bondholder. A bond convertible bond offers investors a type of hybrid security that has features of a bond, such as interest payments, while also having the option to own the underlying stock. Convertible bonds are a flexible financing option for companies. A convertible bond offers investors a type of hybrid security, which has features of a bond such as interest payments while also providing the opportunity of owning the stock. This bond corporation ratio determines how many shares of stocks you can get from converting one bond. For example, a 5:1 ratio means that one bond could convert to 5 shares of common stock. So, here are the pros and cons of the convertible bond. So, first, investors receive fixed rate interest payments with the option to convert the stock and benefit from stock price appreciation. Next, investor gets some default risk security since bondholders are paid before common stockholders. And companies benefit by raising capital without immediately diluting their shares. And lastly, companies may pay lower interest rates on their debt compared to using traditional bonds. And the cons are, due to the option to convert the bond into common stock, they offer a lower coupon rate. Issuing companies with little or no earnings with startups create an additional risk for convertible bond investors. Share dilution happens if the bonds convert to stock shares, which may depress the shareholders, the share price, and EPS dynamics. So, the last type of bonds is that the high-yield bonds or junk bonds are those debt securities issued by companies with less certain prospect and the greater probability of default. These bonds, therefore, are inherently more risky than bonds issued by more credit-worthy companies. But with greater risk also comes greater potential for return. Identifying junk bond opportunities can boost a portfolio's performance. And diversification through high-yield bond ETFs can cushion any one poor performer. High-yield bonds are not intrinsically good or bad investments. Generally, a high-yield bond is defined as a bond with a credit rating below investment grade. High-yield bond is more highly correlated with stock market performance than is the case with higher quality bonds. When the economy weakens, profits tend to decline, and so does the ability of high-yield bond issuer. Generally, to make interest and principal payments, this leads to declining prices on high-yield bonds. Declining profits also tend to depress stock prices. So you can see how economic news or good or bad could cause stock and high-yield bonds to move in the same direction. So next, let's move on to provision of prepayment. So first, we have call feature. A call feature is a feature in a bond agreement that allows the issuer to buy back bonds at a set price within certain future time frames. The issuer uses a call feature to hedge against the interest rate risk. Bonds can be bought back and replaced by bonds carrying a lower interest rate if interest rates decline. This feature may limit the amount of money that a bondholder might otherwise be able to earn by holding a bond. So, investors demand a higher effective interest rate when a call feature is present. Next, sinking fund. Sinking fund is a fund containing money set aside or saved to pay off a debt or bond. A company that issues debt will need to pay that debt off in the future. And the sinking fund helps to soften the hardship of a large outlay of revenue. A sinking fund is established so that the company can contribute to the fund in a year's lending up to the bond's maturity. And lastly, the serial bond. Ito daw po yung bond that issue structure so that the portion of the outstanding bonds mature at regular intervals until all of the bonds have matured. because the bonds mature gradually over a period of years. These bonds are used to finance projects that provide a consistent income stream for bond repayment. The entire bond issue is sold to the public on the same date, and the maturity date are stated in the offering documents.
Now, let's proceed to our objective number 4. In here, we were going to discuss why federal, state, and local government issued bonds and why investors purchase government bonds. Government bonds and debt securities. The U.S. government and state o local government issued bonds to obtain financing. So, yung mga funds daw na inuutang ng gobyerno, ng bangko, at ng gobyerno ay ginagamit pang funds or pang provide dun sa mga ongoing activities like schools, airports, and many more. Now, there is a question here that is interesting to answer. So, why purchase United Treasury securities, or what are the reason or the benefits that an investor can gain in purchasing a government or a U.S. Treasury securities? So, the reason why investor purchase a Treasury securities is because that U.S. Treasury securities are considered ultimate safe investment with little risk. The quality is higher than other investment. Third is, it is backed by full faith and credit of the U.S. government. Fourth is, it carry a decreased risk of default. And lastly, it can allocate their investment asset and lessen overall risk. Now, let's proceed to the different type of security bills. As you can see in the screen, we have a treasury bills. So, treasury bills are sometimes what we call a T-bill. Treasury bills have the shortest maturity terms. It pays no interest but is almost always sold at a discount to its par value or face value. T-bills is sold in a minimum unit of 100 pesos with additional increments of 100 pesos above the minimum. The maturity for T-bills may be as long as 1 year. However, the Treasury Department currently only sells T-bills with 4-week, 13-week, 26-week, and 52-week maturities. Another type of T-bills that is issued in terms usually shorter than those other T-bills is what we call cash management bills. As you all know, T-bills are discounted securities, and the actual purchase price you pay is less than the maturity value of the T-bill. Here, we have a computation, and to get the current yield, you have to divide discount amount and purchase price. Next is Treasury notes. Treasury note is sometimes called a T-note. It is issued in 100 pesos with a maturity of more than 1 year but not more than 10 years. Typical maturities are 2, 3, 5, 7, and 10 years. Interest rates for Treasury notes are slightly higher than those for Treasury bills because investors must wait longer to get their money back and therefore demand a higher interest rate. Interest for Treasury notes is paid every 6 months until the maturity. Notes can be held until maturity or sold before maturity. Now let's proceed to the third part of security bills. It is a treasury bonds. So a treasury bond is issued in a minimum units of 100 pesos that have a maturity of 30 years. Interest rates for treasury bonds are generally higher than treasury bills and treasury notes. Again, the primary reason for the higher interest rates is the length of the time investor must hold a treasury bonds. Like interest on treasury notes the interest on treasury bonds is paid every 6 months until the maturity. Bonds can be held until maturity or sold before maturity. The next step that we have is Treasury Inflation Protected Securities, or what we call TIPS. Treasury Inflation Protected Security, or TIPS, are sold in minimum units of 100 with additional increments of 100 above the minimum. Currently, TIPS are sold with 5, 10, or 10-year maturities. The principal for TIPS security increases with inflation and decreases with deflation, as measured by Consumer Price Index. When TIPS mature, you are paid the adjusted principal or original principal. TIPS also pay twice a year at a fixed rate. The rate is applied to the adjusted principal, so like the principal, interest payment rise with inflation and fall with deflation. Interest income and growth in principal are exempt from state and local income taxes, but are subject to federal income tax. Like other treasury securities, TIPS can be held until maturity or sold before maturity. Now let's proceed to the federal agency debt issues. As you can see in the screen, we have Federal National Mortgage Association, or sometimes referred to as Fannie Mae. Next is Federal Home Loan Bank System. Another is Government National Mortgage Association, or sometimes referred to as Ginnie Mae. And lastly, the Federal Home Loan Mortgage Corporation, which somehow become known as Freddie Mac. So, these are the security issued by the Treasury Department. Let's proceed to the municipal bonds, or what we call a MUNI. So, municipal bonds are defined as debt security issued by a state or a local government such as cities, counties, school districts. So it is used to fund for ongoing costs and major projects such as schools, airports, and bridges. So municipal bonds now is classified with two types, which is general obligation bonds or the revenue bonds. So the difference between two is general obligation bond is a bond backed by the full faith, credit, and ultimate taxing power of the government that has issued it. And on the other hand, revenue bond is a bond that is repaid from the income generated by the project it is designed to finance. Taxable equivalent yield. So we have here, as you can see in the screen, equation. And for you to get the taxable equivalent yield, you are just going to divide the tax exempt over 1 minus your interest rates. So that's all for our objective number 4.
Objective number 5. Evaluate bonds when making an investment. One basic principle we have stressed throughout this text is the need to evaluate any potential investment. Certainly, corporate and government bonds are no exception. Only after you have completed your evaluation should you purchase bonds. In this section, we examine methods you can use to evaluate bond investments. The Internet. You can analyze a stock investment using the Internet, and you can evaluate a bond investment using a lot of the same financial data. You can learn a lot about a company and its current financial situation by visiting its websites and looking for the sections titled Financial Information, Annual Report, or Investor Relations. Additionally, a business may provide many yearly reports on its website, allowing you to compare reports from different years. When investing in bonds, you can use the Internet in 3 other ways. First, you can obtain price information on specific bond issues to track the value of your investments. Second, it is possible to trade bonds online and pay lower commissions
than you would pay a full service or discount brokerage firm. Third, you can get research about corporate and government bonds issues, including recommendations to buy or sell, by assessing specific bond websites. Note that bond websites are not as numerous as websites that provide information on stocks, mutual funds, or financial planning, and many of the better bond websites charge an annual subscription fee to access their research and recommendations. The clean price represents the price of a bond with no accrued or earned interest. Dirty price of a bond represents the price of the bond plus accrued interest earned by the bond owner since the last interest payment date. For government bonds, most financial publications include two price quotation. Price quotation, or the bid price, is the price a dealer is willing to pay for a government security. The bid price represents the amount that a seller could receive for a government bond. The second price quotation, or the ask price, represents the price at which a dealer is. The second price quotation, or the ask price, represents the price at which a dealer is willing to sell a government security. The ask price represents the amount for which a buyer could purchase the security. For example, assume that Samantha Carly owns a $1,000 corporate bond that pays 6% interest. She receives her regular semi-annual interest payment on June 1. 2 months later, she decides to sell her bond. In this case, the buyer will pay Samantha the dirty price, which includes the quoted price of the bond plus interest for the 2-month period since Samantha's last interest payment. When the next semi-annual interest payment date arrives, the buyer will receive the full interest payment. Annual reports. Bondholders must be considered about the financial health of the corporation or government unit that issues bond. Consider the following 2 questions. Will the bond be repaid at maturity? And will you receive interest payments until maturity? There are 2 ways to obtain a corporation's annual report. First, you can either write or telephone the corporation and request an annual report, or 2, most corporations maintain a website that provides access to annual reports and detailed information about their financial performance. The annual report to shareholders is a document used by most public companies to disclose corporate information to their shareholders. It is usually a state-of-the-company report including an opening letter from the executive officer, financial data, results of operation, market segment information, new product plans, and research and development activities on future programs. Reporting companies must send annual reports to their shareholders when they hold annual meetings to elect directors. Under the proxy rules, reporting companies are required to post their proxy materials, including their annual reports, on their company websites. There are 4 definitions of bond rating. A bond rating is a way to measure the creditworthiness of a bond, which corresponds to the cost of borrowing of an issuer. These ratings typically assign a letter grade to bonds that indicate their credit quality. A bond rating is a letter-based credit scoring scheme used to judge the quality and creditworthiness of a bond. Investment-grade bonds assign AAA to BBB ratings from Standard & Poor's and AAA to Baa3 ratings from Moody's junk bonds have lower ratings. The higher a bond's rating, the lower the interest rate it will carry, all else equal. What is bond yield? There are 4 definitions of bond yield. Bond yield is the return an investor realizes on an investment in a bond. A bond can be purchased for more than its face value at a premium or less than its face value at a discount. The current yield is the bond's coupon rate divided by its market price. Price and yield are inversely related, and as the price of a bond goes up, its yield goes down. Yield is the rate of return earned by an investor who holds a bond for a stated period of time. A current yield is determined by dividing the annual dollar amount of income generated by an investment by the investment's current market value. The formula for current yield on a corporate bond is current yield on a corporate bond equals annual income amount over current market value. An example of current yield calculation is Assume you own an E-Trade financial corporate bond that pays 7.375% interest or $73.75 each year until the bond's maturity in 2013. Also assume the current market price of the E-Trade bond is $950. Because the current market value is less than the bond's face value, the current yield increases to 7.76 as shown below. Yield to maturity. A yield calculation that takes into account the relationship among a bond's maturity value, the time to maturity, the current price, and the dollar amount of interest. In this situation, the yield to maturity takes into account two types of return on the bond. First, you will receive interest income from the purchase date until the maturity date. Second, at maturity, you will receive a payment for the face value of the bond. If you purchase the bond at a price below the face value, the yield of maturity will be greater than the stated interest rate. If you purchase the bond at a price above the face value, the yield to maturity will be less than the stated interest rate. Remember, the actual price you pay for a bond may be higher or lower than the face value because of many factors, including changes in the economy, increases or decreases in comparable interest rate under investments, and the financial condition of the company. At least part of the reason the E-Trade bond in this example is priced below the $1,000 face value is because of the corporation's B rating issued by Fitch, a major bond rating service. The yield to maturity calculation is an annualized rate of return if the bond is held until maturity. If the bond is sold before maturity, the rate of return for the investor may be higher or lower, depending on the price the bond is sold for and the length of the time the bond is held. Like the current yield, the yield to maturity allows you to compare returns on a bond investment with other investments. Also, like the current yield, the higher the yield to maturity, the better.